It's been a severe up and down 24 hours for investors, but markets are now showing some signs of recovery after yesterday's big losses. Japan's #1 stock index gained more than 10% overnight after dropping 12% just one day ago. The Dow, Nasdaq, and S&P futures are also all up after they fell about 3%. Martin Baccardax joins me now to speak more about this. He is the senior editor-in-chief markets correspondent at TheStreet. Martin, thanks for helping us with this. Help us understand, first of all, what fueled this mess and all that chaos yesterday.
It's a great question, and to be frank, all of us are sort of debating exactly what the trigger for it was. There's a couple of aspects I think that we've been focused on. The Federal Reserve last week, for example, decided not to raise interest rates, not to cut interest rates, even though we were seeing weakness in the job market and in the broader economy. We're also seeing these geopolitical tensions that you've alluded to in your programming. But I think the most significant was an event that we saw in Japan, where investors had borrowed money at effectively zero rates and then used to convert that into U.S. markets. Now, the Bank of Japan has actually risen interest rates to fight inflation. So we've had to unwind that trade. In other words, investors in foreign countries have had to sell U.S. assets and then repurchase yen in order to get back to zero. And that really executed what we saw yesterday on Wall Street and explains why we had the biggest decline in Japan since 1987 yesterday and such a comeback today. And that further explains why we're seeing a little bit of stabilization this morning.
Okay, good to see that stabilization. I wonder, Martin, though, what this says about whether or not a recession is coming.
It doesn't appear so yet. There are some indications in the labor market that we're close to recession, but that probably won't materialize for a number of months. When we look at GDP indicators at the moment, the growth rate is actually quite healthy. And the growth rate for the second quarter, i.e. the 3 months that ended in June, was also very strong as well. But there are underlying concerns, particularly in jobs, but also in activity indices that do suggest there might be some weakness into the back half of the year. There's everything to play for, to be honest, and I don't think the jury is out just yet, but there are enough signals that investors are getting a little bit nervous and moving away from risk assets such as the stock market into safer assets such as gold and treasury bonds.
And Martin, you mentioned off the top there that you believe the Fed decision not to take any action on interest rates last week may have factored into what we saw happen in the markets yesterday. Can the Fed cut rates before its next meeting?
I think it is possible. There are emergency rate cuts that we have seen in the past, but I think that would probably spook markets more than what we saw yesterday, because people would assume that the Fed is seeing something that investors are not. There's going to be a keynote address from the chairman, Jerome Powell, later this month in Jackson Hole, Wyoming. We're all going to be laser focused on that. But I think it's very unlikely we'll get that emergency cut. And therefore, the focus then will shift to the September 18 meeting, when we expect not only a quarter-point rate cut, but very likely a half-point rate cut as the Fed plays catch up to what the markets are anticipating.
Okay, interesting. We'll have to keep a close eye on this. Martin Baccardax, thank you.
Thank you.